So today we're going to talk about how short sales work in the stock market. Now, a short sale is where you sell something you don't own. You borrow it and then you sell it. It's something that exists only in the stock market. It does not exist in real life. But if it did, my friend the minion is going to help us explain it. I borrow this minion from my friend. A minion sells for about $25 in the store. So I borrowed the minion and I immediately sell it to a third person. Now I have $25 in my pocket. There's three possible outcomes to what I've done here. One is that a couple of months from now, I go back to the store. Minions are still $25. I buy a minion back for the $25 that I got from selling him. I give the minion back to my friend, and I'm about even. The second possibility, and this is the one that short sellers are hoping for, is I go back to the store in a couple of months. There's thousands of minions still in the store. They've reduced the price to $15. I buy another minion for $15. I give the minion back to my friend. Now I still have $10 in my pocket from the steal. The third possibility, the one that a short seller will be afraid of, is that something happens that drives up the price of the minion. So there's an online influencer. They say that minions are the best thing ever. You need a minion. All of a sudden, millions of their followers are buying minions. I go to the store, there's no minions left. I have to go online and I get a minion for $35. So I've spent $35. Now I give the minion back to my friend and I've lost $10 on the deal. So that's how it would work in real life. Now in the stock market, it works a little bit differently. In the stock market, if you have a brokerage account, you're going to have three choices. You can buy stocks, you can sell stocks, or you can sell them short. And when you sell short, you're picking a corporation where you think the stock price will go down. So you're doing the opposite of what we usually say in the stock market. In the stock market, they say, you should buy low and sell high. When you're short selling in the stock market, what you're doing is you're selling high and then hoping to come back and buy low. So in the stock market, you have Consolidated Toothpick Incorporated. It's selling for $50 a share. You go onto your brokerage account, you short sell the stock at $50 a share, 100 shares. Now there's $5,000 in your account. So eventually you'll do again one of the three possibilities. One is that a few months from now, Consolidated Toothpick is still selling around $50 a share. So you're about even. You take your 5,000, you buy back those 5,000 shares, and your account is even. The possibility the short seller is hoping for is that the stock price has gone down. Now Consolidated Toothpick is 25 a share. So you take 2,500 from your account to buy the 100 shares back, and you have $2,500 still left in your account as profit for yourself. The third possibility is that the stock continues to increase in price. Now Consolidated Toothpick has gone from 50 to 75, maybe even 100 or $200 a share. So your losses are unlimited. So if you buy it back at 75 a share, now you've lost $2,500 on your short sell. And your losses are unlimited. You can imagine if the stock goes to 100 or to 200 or to 300, there's no limit to losses. So it's a very risky strategy to use. So to sum up, short selling is a strategy, a risky strategy that investors can use. It's one of several strategies that are available to investors. And as an investor, you just need to do your research and hope you have some good luck.